Hello, everybody, and welcome to the Tortoise channel. Happy Tuesday. If you are new here, welcome. If you are not, well, this will provide value anyway. And the reason I'm recording this video today is because, well, it follows on from some of the comments that I read, had the opportunity to read, to some of the videos that I've been posting. And I realize that some of you have been using leverage, right? And I think that's a big mistake. And so today I want to focus on what can really allow us as investors to build a lot of wealth long term without using any leverage, but just by exploiting gaps between value and in value and price. All right. So if you are using a lot of if you are one of these people using leverage because you want to accelerate your growth, because you want to accelerate your rate of returns, bear in mind that the opposite is the flip side of that is that you can also compound your returns negatively. And in case you didn't know, I'm going to share you right here this. So you of course feel free to take a screenshot if you want, but this is essentially how long it takes to break even after a loss, and many of us are not aware of that, and that's the big mistake. So for example, if you lose 60% of your account, you will need a 150% gain just to break even. We are not even talking about making money. We are talking about simply breaking even. And if you lose 70% of your account, you need 233% a 233% gain just to break even. So avoid leverage, because the stock market is the only place in the world where you can actually find those big gaps between price and value. And once you buy a well-established company with sound fundamentals, it will just be a matter of time before the market realizes that and reprices that company accordingly. All right. And I want to talk about this here today. The name of the channel and the name of the company that I started is Like a Tortoise for a reason. Slow and steady wins the race. So right now, I'm not sure if you guys are even aware of that, but this research was put out by JP Morgan, and basically it studies the annualized returns by asset classes from 2002 all the way through 2021. And you can see that while the market average achieved about 9.5%, the average investor, so people like you and me, it only managed to achieve 3.6% annualized returns. And the reason is exactly for what I was pointing out. Number one, people are using a lot of leverage. They are trading as opposed to follow sound principles, a time-tested framework that has worked out over time. They want to accelerate the rate of returns at a great cost, right? At the cost of blowing up their accounts, and then they have to start all over. And those mistakes add up easily and will stop you from achieving sustainable growth over time. In fact, if I show you more data here, I'm a very visual person, and so everything that I do, I like it to be backed by data. And so if I go, for example, I want to show you this chart right here. I was actually on a call not that long ago, and this is the exact chart that I showed. You can see that the probability of losing money actually decreases over time. So the longer you stay invested, and bear in mind that this goes back to 1970 all the way to 2023. And what it shows you is that the longer you stay invested in the market, the lower the probability of losing money. All right. So time in the market beats timing the market. That's what I want to say. If you are a short-term trader or a swing trader for that matter, the probabilities are no longer in your favor, and you can make a lot of money doing that, but it's a day job. Okay, and as with investing, you also have to stick to to a sound framework that has worked many years, that has worked very effectively over time. Okay, so it's not, otherwise it's gambling, and the trading and gambling are not the same thing. Okay, and so this is what I wanted to point out. But based on my personal experience, if you, on the other hand, want a more laid back approach to investing, while stacking the odds greatly in your favor, minimizing any unnecessary risks, what happens is, as you can see right here, the like a tortoise way is the approach for you. And for example, let me show you this. This is essentially the framework that I use, right? Which is our winning formula that we choose for choosing investments. And that includes buying companies with a meaning to us, with a competitive advantage, that means moat, with a great management team in place, and also, perhaps even more importantly, with a margin of safety. The company can tick off all these boxes, but if it doesn't meet the criteria in terms of margin of safety, that's a big red flag. Okay, it doesn't matter how great the company is. Even great companies become poor investments if you end up overpaying. So I want my margin of safety. And this strategy is quite laid back because most of the time you do nothing. But because you are selecting companies based on a set criteria, the chances are that you will end up greatly outperforming the market over time. All right. And if I showed you the returns of the Like a Tortoise portfolio that I started almost 2 years ago, and that you can see right here very transparently, you can see that if I go to performance and if I expand this, you will see that the annualized returns are currently hovering around, let's see, let's expand this as well. Here we go. So annualized returns of the portfolio are about at 32.77%. Okay, so at 32.77%, you are, let me minimize this, you are essentially doubling your money every 2.4 years. Well, even sooner, but just about 2.4 years. Do I think these returns are going to persist over time? I mean, these annualized returns, I don't know. What I do know is that our minimum acceptable rate of return is always 15%, which means a double every 4 to 5 years. But in all fairness, I do think you will achieve greater returns because the companies in our portfolio, number one, are priced cheaply, cheaper compared to the benchmark, and number two, they have more sound fundamentals. So they are better across different metrics like not only valuation but also profitability, balance sheet strength, leverage, and so on and forth. And so it makes sense for us to continue to outperform over time. And most importantly, I don't feel any FOMO, guys. I see many of you leaving comments here that shows me that you guys feel a lot of FOMO. So, for example, I think one of you even bought shares in PayPal recently simply because I put out a video and believed the company was going to go much higher without doing proper due diligence. And you have to do proper due diligence no matter what no matter what somebody tells you. All right? Because even though we can own the same investments, there is a big difference between understanding what you own and being clueless. And that's a recipe for disaster because you will panic sell at the small, at the slight hint of trouble. Okay, and that means you will end up being just an average investor achieving well below average rates of return. Okay, so I think education is important, but if you stick to our framework of buying high quality companies led by outstanding managers when and only they are trading with a margin of safety, you will make a lot of money over time. And you can see that diversification becomes just a myth. I don't diversify. I try to understand a few handful of companies that very well, that companies that I have a high conviction in, and then I go all in. Okay, I take concentrated bets with real money, and you can see some of them right here. Some of these bets have already worked out nicely, and the prices have already left the station, as I normally say. Others are still lagging, but I think it's just a matter of time before we start seeing some similar explosive moves, in my opinion. Okay. So this is very important, and I do hope it managed to shed some light on what I teach and what my principles and values are. And seeing some of your comments showing me that you guys are feeling a lot of FOMO, seeing your comments, right? And some of you are quite transparent. You say, look, I'm down 12K on my CFD position. I bought PayPal and invested 92K just because you created a video and you explained the company and the thesis very well. That is not a reason to buy anything. Okay, so this is why I wanted to stress with this video, and I hope it managed to bring more value to our community here on the Like Tortoise channel, and so yeah, just understand what you own, and leave in the comments in this video if you want me to discuss anything else regarding fundamentals or my approach in more detail, or any other examples, and I'm more than happy to do so. Also, of course, I have a community of long-term investors where I share. I have both a WhatsApp community and the school community, where I share a lot of information on finance, investments. I provide a lot of insights into my own portfolio, and you can join both these groups for free. In fact, I'm going to leave, as I normally do, I leave the link in the video description, so you can just go there, and I will bring you directly to our school community page, where you can just add. Just send me a message, and I will gladly welcome you to the platform. And yeah, man, it's all about education. I lost 10K at the beginning of my trading journey exactly due to lack of education. I thought I could go out on my own, and that was a big mistake. And unfortunately, it was just 10K. And I realized my mistake soon enough, and I acted immediately. And I see many people delaying taking the necessary steps, and they continue to greatly underperform. Not only underperforming the market, but also losing money, which is the worst case scenario. Okay, so yeah, let me know if you like this video, and I'll be more than happy to create other videos like that. Thank you, guys. Enjoy the rest of your day.